All right, let's go ahead and get started here. Welcome to our webinar. The audio on our initial recording had a bit of an issue, so I'm going to just re-record this for you all. We are GDI Capital Partners. This presentation is relating to Tranche 1 of our fund, where we will be detailing our diversified investments in Tommy's Express car wash development, as well as a 40-well oil development project. A couple quick housekeeping items before we get started. This is a 506c offering for accredited investors only, which simply put, if you're not familiar, to be considered an accredited investor, an individual neither needs to have a net worth of at least $1 million, not including the value of their primary residence, or have an annual income of at least $200,000 per year for the past 2 years if single, or $300,000 for a married couple, and also have the reasonable expectation of reaching that same income level in the current year. This next blurb is a disclaimer. This is prepared by our SEC attorney. We encourage you to read it in its entirety, but for the sake of time, I'll just summarize the highlights of it. It says that this business plan is confidential. It's intended solely for informational purposes, not as a solicitation or securities offering. The information provided is believed to be reliable but not guaranteed, and all investors should independently verify details and consult legal and tax advisors due to the nature of the investment. Forward-looking statements within the plan are predictions subject to uncertainties, and financial projections are based on assumptions that may not reflect actual future performance with no guarantee of achieving projected results. Again, that is a brief summary, but please read it in its entirety. Let me first introduce you to our team and partners real quick, and then we'll get into the meat of the presentation. So here's your GDI Capital Partners team. Brandon Wong is our CEO. He holds an executive MBA from TCU. He's also a Marine Corps veteran. He dedicates a lot of his time helping vets learn business and finance as they transition to civilian life. I am Mike Herman. I'm our senior underwriter with over 100 hours in financial analysis and modeling training. When I'm not nerding out on an Excel spreadsheet, you can find me at my other job where I'm a flight nurse on an EMS emergency helicopter in Northern California. Andy Eddy is our senior asset manager with over 30 years experience in commercial real estate business. He's overseen multiple seven-figure transactions and project management. After seeing firsthand the risks and struggles that can be realized through single asset, single geography investments, we created GDI Capital Partners to be a fund that is dedicated to bringing investment opportunities that serve our core four objectives. And so we look first and foremost to mitigate risk through diversity in asset classes and asset locations, because our number one priority is to preserve investor capital. Then we look for assets that provide potential for significant equity multiples, in this case such as car wash development, while pairing that with an asset that also provides a potential for strong monthly cash flow, such as oil and gas development. And then all while providing potential for significant tax savings that can actually be utilized by our investors who work active W-2 jobs. And the reason I mention this part is because many assets such as apartments, self-storage, ATMs, they have tax benefits that do not necessarily benefit W-2 employees. However, as we'll discuss in later slides, oil and gas investments actually can. But whenever, of course, we talk about taxes, we want to include the disclaimer that we are not tax experts and your situation will be unique to you. So please consult with your CPA. Moving on to the operations team of the Tommy's Express car wash development portion of the fund. Tommy's is a franchise business model, and our partners at Olympus Pines are on track to become the largest Tommy's franchisees in the country by early 2025. Trevor Sperry is the CEO of Olympus Pines. He has extensive background in strategy and finance. Michael Cianelli is the COO of Olympus Pines, leading operations and marketing. He's a former Apple executive. Alex Lehman is the CEO of the Tommy's Express franchise. He's a strategic advisor to Trevor and Michael as they develop franchises across the country. For the oil and gas portion of the fund, Stephen Ford is the lead operator with over 1,500 wells drilled in the region. He has extensive knowledge of the industry. Kevin Fowler is the petroleum geologist with over 30 years of experience, including as a senior geologist for Marathon for 8 years. He's also drilled around 300 wells in this region. Sean Pruitt is the fund's main point of contact. He's responsible for timely investor communications. Our SEC documents and legal advisement have been provided by Premier Law Group. Our CPA services are provided by Landmark. They have extensive experience in partnership returns. We're using Verivest for our fund administration and accounting. It's important to us to have an independent third party managing our books. And then we'll be using Mercury for all of our banking needs, and they have just been fantastic. Now to the fun part, let's get into the projections. So for this tranche, we're raising $2.2 million. We're projecting a 16.3% IRR, an 18.6% average annual cash flow, and a 1.8x equity multiple over a 5-year period. If you aren't familiar with the metric IRR, it stands for internal rate of return, which simply put, the IRR takes into account the time value of money. So as an example, say you invested $100,000 and 5 years later you received $200,000. You would have made $100,000 over 5 years for an average of $20,000 or 20% a year. However, due to the time it took, in this case 5 years, your IRR would actually be less than 20% per year because the value of the dollar decreases over time. It is important to note that while our projections are over that 5-year hold, this is really based on the Tommy's Express car wash to be sold within a 5-year period. However, the oil project will continue to cash flow until the wells are no longer economically viable, which could be much longer than 5 years, even potentially decades longer in some cases. So let's look closer at how this looks over the 5 years using our diversified approach. As you can see in year one, we are not projecting any cash flows whatsoever. And this was important to us to see what returns would be if we made nothing in year one. So while we do certainly expect to have some cash flows from the oil development within that first year, we wanted all that to be on top of our projections here, just to allow for any unforeseen circumstances or delays in development. In year two, we see a pop in cash flows as the wells come online, and then a slow tapering of cash flow as the flow from the wells decreases after the initial gush of production. Since we'll be investing in a fund that is developing a segment of Tommy's car washes, we do have the potential to benefit from cash flows from those sites in the first year or two as they open for business, but we don't ever even start projecting those operational cash flows until year 4, just to be on the safe side. In year 5, we see another big pop. This is from the projected sale of the entirety of the Tommy's Express car washes that were developed over the preceding years. While we will be investing in the development of a portion of the sites being built by Olympus Pines, when they go to sell, the plan is to sell all of the locations as a package to an institutional buyer, at which time we will benefit from the sale of the entire portfolio based on our pro rata share. So by this time, all the investor capital will be returned, and so while our projections are based on that point, we do project monthly distributions to continue as oil continues to flow. And at that point, the returns are going to be considered infinite because all investor capital is returned. Let's look at some of the tax benefits of these investments. We know this is a busy slide, so bear with me. On the left side, on the car wash development side, car washes have the potential to benefit from substantial bonus depreciation once certificate of occupancy is issued, but whether or not you'll be able to use this depreciation offset your income depends on your unique situation. So again, we urge you to consult your tax professional. But my personal favorite part is on the right side, on the oil and gas development side, thanks to the ability to offset active income through intangible drilling costs. We're able to do this because our fund will be investing initially as general partners until the tax allocations are made, which is typically after the first year, and then will be converted to limited partners. So walking you through this example, let's say you're a high income professional, you make $400,000 a year and invest $100,000 with our fund. Well, we're going to put 50% of that with the car wash development and 50% or $50,000 that will be invested in the oil project. So if we project 75% of that $50,000 to be classified as IDCs or those intangible drilling costs, we'll be able to deduct $37,500 from our taxable income in year 1, making our new taxable income $362,500. So assuming this investor is in the 35% federal tax bracket, this results in a tax savings of $13,125, which that's a savings that isn't even factored into our previous projections. So there are also opportunities for further tax savings with tangible drilling costs and depletion. We're not even factoring those into this. Those are all just going to be bonus deductions for us. In full disclosure, due to the nature of these investments and the need for our fund to receive tax documents from both of these operators, we do expect a delay in our CPA's ability to prepare tax documents for our investors. So we just want to make sure you know that you're very likely going to need to file an extension with the IRS come tax season. Now let's take a look at the investor-friendly structure of our fund compared to the majority of funds. So we're offering a 10% preferred return, or a pref. This is based on the initial contribution from the investors, not the investor unrecovered capital account. So typically the way these funds work, as capital is returned to the investor, the amount that the 10% pref is based on decreases. So as an example, if you invested $100,000 in a normal fund and that fund was able to return 10% or $10,000 to you in year 1, your unrecovered capital account for year 2 would be $90,000, which decreases your pref to 10% of that $90,000 or $9,000 for that year. Well, with our fund, the pref is always based on your initial contribution until there is a full return of capital. So if you invest $100,000, your annual pref will be $10,000 until your $100,000 is returned in its entirety. Going back to the taxes, any depreciation benefit the fund receives will all be passed on to the investors, unlike other funds where the managers may take a cut of the depreciation. Once our investors receive a full return of invested capital, all future cash flows will then be split 90% to the investors and 10% to the managers, with no IRR hurdles to limit investor upside. Other funds can get complicated with multiple hurdles and splits that heavily favor the managers and limit investor upside. Other funds can also charge a 2 to 3% acquisition fee and a 2% asset management fee that can begin day one. So they're making money right out of the gate. Our fund has a modest 1% acquisition fee and a 1% asset management fee that begins only once distributions begin to investors. So if you aren't making money, neither are we. And the reason we structured it this way is really because we are investors first and we'll be investing right alongside you. And we have all invested passively across a range of asset classes, and we're just tired of seeing managers and general partners make money while the investors are left with little to nothing. So we truly hope this model will ensure our investors are well taken care of. Typical funds are open and left to the fund manager to decide what investments enter the fund, leaving the investors blind and completely trusting the manager. Our fund is structured in such a way that we have tranches where the investments being offered in each tranche are going to be identified ahead of time. So you can get to know the assets, determine if they're a good fit for you. This model also protects investors in each tranche from being diluted by future investors in future tranches. So in tranche 1 for us, we have Tommy's Express car wash development. We have oil and gas development. That's it. In tranche 2 is not open. We don't have anything defined for that tranche yet. We will when that time comes after we're done with tranche 1. It might be the same thing. It might be something different, but investors will know what it is ahead of time, and same with tranche 3, tranche 4, and so on. So now let's get into the details of these assets. And first, why did we pick Tommy's Express car wash development? Well, Tommy's Express locations are absolutely stunning. Their design and their efficiency. Brandon likes to say that they're what would be the result if Apple and Tesla created a car wash. The up and coming generation, consumer behavior has drastically shifted away from that do-it-yourself mentality, pull the car into the driveway and get out the sponge and wash it, to a more convenient do-it-for-me model. And so people want to save time. Consumers are looking to outsource tasks like washing their car. So they're drawn to these attractive locations that are convenient, they're efficient, there's high quality service. They can just pull in on their way home from work and just get it done, and have a subscription-based model that they can just go in whenever they want. Tommy's specifically has redundant equipment, and they have automated notifications that let employees know if a product is getting low. This significantly limits downtime. They also have their own supply chain, and each site actually only requires 12 employees total. And so they only need 3 or 4 on at a time, which keeps operating costs very low. And so due to these operational efficiencies, they can wash up to 3,000 cars per day, which is quite impressive. On a per location basis, the average Tommy's after stabilization can operate on a 50% margin, generating $2.6 million in revenue with $1.3 million in earnings before interest, taxes, depreciation, and amortization, known as EBITDA. When it comes time to sell, these numbers should generate quite a bit of institutional investor appetite. When it comes to site selection, our partners at Olympus Pines are very particular. They're looking for highly visible locations with multiple entry points, speed limits less than 40 miles an hour, and ample parking. The Tommy's Express franchise has best practices for demographic metrics when choosing a site. In this example of an actual current site operated by our partners at Olympus Pines, we can see that they exceed the standards in traffic, population, and income. They also ensure surrounding retail has at least 3 to 4 major brands, which validates the sustainability and retail demand of the area. As of the summer of 2024, our partners have 44 sites in various stages of development across 24 cities, with grand openings occurring nearly every month. By next year, Olympus Pines projects to be the largest Tommy's franchisee in the country. We have the opportunity to be a part of that. Moving on to why we chose oil and gas, and specifically this particular project. I'm going to give a high-level overview of it because we are including in this deck a 27-minute video where our geologist Kevin Fowler explains the project in much more detail. We are certainly not experts in oil and gas, which is why we partner with experts like Kevin, so we'd rather you hear it from him anyway. But let me just start with a personal story. The first time I invested in oil drill, it was a single well drill in Louisiana. I didn't know much about it at the time. I was told by the promoter that the project was, quote, low-hanging fruit, which that's red flag number 1, by the way. It didn't take long until I got an email stating we didn't hit oil and the project was a total loss. And since then I have not, and I will not invest in a single drill project again. So the site we're investing in is called the West 5 Mile Project. It is a 40-well drill. This spreads the risk. So if one of the wells doesn't produce to projections, there are many others with the potential to make up the difference. As mentioned, our operator, Stephen Ford, has drilled around 1,500 wells in this area, and Kevin Fowler has drilled around 300 wells in this area. Combined, they have only not had oil return on 5 of those wells, and that was due to mechanical failures. So oil is there. It's highly unlikely that we won't hit oil. However, of course, with any investment, there are certainly still risks to be aware of. The main risks here that could impact returns are how much oil is going for at the time, how much at the time of sale, and then how much oil is there and how long will it produce for. Another benefit of this project is Mr. Ford owns his own equipment. There are actually only 600 active drilling rigs in the U.S. right now, and Mr. Ford owns one of them, which is a huge advantage. It saves us both time and cost. We don't have to wait for a drilling company to become available to drill for us. Our wells are also considered short vertical drills, typically less than 2,000 feet deep. This saves on cost as deeper wells with horizontal drilling, those take more time and money to complete. Most people probably don't consider New York an oil state. This map shows oil and gas wells throughout the state as of 2021. You can see our project West 5 Mile is located down in southwestern New York. And again, Kevin's going to go much deeper into all this, but if we zoom in on that area, we can see our site is just above the town of Allegheny, New York. And here we can see the 40-well project our partners are currently developing called Wing Hollow is outlined by the light blue color in the shape of a Z. I'm actually personally invested in that project, which is why I'm excited about the West 5 Mile project and why I'm going to invest in this one as well. So at the time of this webinar, they are drilling their last 6 wells of that Wing Hollow project, and all the wells so far that have been completed are producing oil, and quite significantly actually. So our project, the West 5 Mile, the one we're raising for currently, this involves the 2 areas of land right next to the Wing Hollow that you can see there. So notice how there's a parcel of land between the 2 sections of the West 5 Mile. This area is called the Potter Oil Field, and this was drilled in the 1980s. And Mr. Ford actually now owns the lease to this field just mainly for the ease of access to the Wing Hollow and the West 5 Mile projects. But if we look back at records from the Potter Field, we can see various results in the amounts of barrels produced in the first 90 days and the first year of production. Look there at the bottom, kind of middle there, well 15 produced 3,781 barrels in the first year, but well 1 only produced 793 barrels. So you can see there's a little bit of a variance. For our project, we're projecting an average of 2,948 barrels per well in the first year. But it's important to understand how technology has improved in the last 40 years since the Potter Field was developed. In the 80s, they were only exploiting 2 to 3 zones per well, whereas we're going to be completing 6 zones per well. And our frac radius, as Kevin will explain, is quite a bit larger than theirs as well. This will maximize production, of course, increase our chances of obtaining our projections. Here's a quick breakdown of the West 5 Mile economics. We're drilling 40 wells, like I said, at a cost of $192,500 per well. We are projecting an average of 4,639 barrels of oil produced over the first 2 years per well, which will be netting $256,000 per well if oil is at $75 per barrel, making recovery of capital within the 24-month time frame. And now we know we keep saying oil and gas, and all we have covered is oil so far. Well, this is because it is not currently economically viable to sell the gas that's being produced. Our team does have a plan to use the gas to run the wells, which is going to save us on operating costs. This is how the cash flows. We're going to work from oil in the ground to our bank accounts. So oil is produced at the West 5 Mile. It's sold directly to refinery at the spot price of WTI. WTI stands for West Texas Intermediate. It is the primary U.S. benchmark for oil prices. Then 75% of the income is paid directly to the investors from the refinery as a working interest, and 25% of the income is paid to the operators, Stephen, Kevin, and Sean, as royalties for being the operators and leaseholders. The West 5 Mile project has 35 investment units available at $220,000 per unit for a total raise of $7.7 million. Our fund is investing in 5 of these units, or $1.1 million. And because our fund is investing in such a large amount, our investors are being given an additional 0.625% of the royalties, which improves our returns above what an individual smaller investor would receive. So once we receive that, we then pay our share of the operating cost to the operator, and then our fund is left with the remaining cash flow to distribute to investors. This here is the video I was referring to. It's a great 27-minute video of our geologist, Kevin, chatting with Sean, explaining further about the West 5 Mile. He does mention selling gas from this project in this video, which I mentioned for now is on hold, with the plan being just to use the gas for operating the wells. But for the sake of time, we'll let you watch this on your own time, and we'll highly encourage you to watch it, if nothing else, for the education of it. You'll all be given a link directly to this deck where you'll be able to view the video. Let's just wrap this up with 7 reasons why we are excited about this opportunity. First and foremost is the risk diversification between different asset classes and locations, followed by the potential for equity growth through the development of the Tommy's Express car washes across the country, and the potential for consistent monthly cash flow from oil development with the risk spread across those 40 wells. We are partnering with some incredible operators. They're truly experts in their areas. They're generally great people. We have really enjoyed getting to know them as we've been searching for these investments. Of course, there's also the potential for significant tax savings that are actually usable by our W-2 investors, which I'm personally excited about, as I mentioned, as this fits me. And then we give assurance that due diligence has been completed on all of our operators, including site visits and background checks being performed. And then lastly, this is, it's all passive for you. And that's the main goal, is we want you to have a place you can park your money and not have to worry about it or do any work for it. So I did want to answer a few frequently asked questions we have received from our initial webinar and conversations we've had. We've been asked if investors can invest in just the car wash portion or just the oil portion of this fund. For this initial tranche, the answer is no. That's simply because the design of it is for the projections is to diversify between an asset that provides an equity multiple for full return of capital within that 5-year time frame, but then also have an asset that provides consistent monthly cash flow that continues long after investor capital is returned. Another question we get is, can I invest with a self-directed IRA or a solo 401k? Yes, you can, as long as your provider allows for it and the proper rules are followed. Let us know if this is something you're interested in. We can help work with your custodian to ensure it's done correctly. Lastly, being that it's approaching the end of 2024 this time, we're asked if the tax deductions from oil will be usable for 2024 tax returns. The answer to that is yes. In fact, with oil, we actually have until the end of March 2025 to use the funds and still be able to use the deductions in 2024. So that shouldn't be no problem there. As far as next steps, if this opportunity sounds like a good fit for you, head on over to investwithgdi.com and register with Verivest. Then you're going to want to click Invest Now and set up a profile, review the documents. If everything looks good, sign it and receive wire instructions and send the wire. We do have to verify that you meet accredited investor status part of this process. And of course, you can always reach out to us anytime if you have any questions. You can book a call at gdicapitalpartners.com/Zoom. You can email us. My email is mike@gdicapitalpartners.com. We also have Brandon at gdicapitalpartners.com or Andy at gdicapitalpartners.com. So feel free to ask us anything you like. Thank you so much for your time. We look forward to partnering with you.